So you just hired your first helper and you're paying them as a 1099 contractor. Smart move, right? You get to save a ton on payroll taxes and avoid all that complex paperwork. But what if I told you that that smart move is actually a massive IRS red flag that could end up costing you tens of thousands in penalties? You know, so many business owners walk right into this trap, and by the time they realize it, it's too late. The penalties can be absolutely devastating. Seriously, they can end a business before it even gets off the ground. Right now, I'm going to walk you through the simple framework the IRS uses to classify workers. This will help you protect your business and your bank account. Getting this right isn't just about following the rules, it's about building a rock-solid foundation for your company's future. We're going to skip the dense legal speak and give you the clear, actionable info you need to make the right choice with total confidence. All right, so let's dive into it and let's just talk about this total scenario. If you're looking to bring on a worker for your business, but you're wondering, should they be brought on as a contractor, a 1099 contractor, or an employee, a W-2 employee? And there's big differences between the two, which we're going to discuss later, from how they get taxed, how it's treated on a payroll aspect. But that's a decision that you have to make. And if you make the wrong decision, there could be massive IRS and state penalties. You know, misclassifying a worker from classifying them as an independent contractor when they should have been a W-2 employee can involve back taxes, income taxes, Social Security, Medicare, FICA taxes. It can involve penalties and interest. It can even have some state level fines and audits, especially in California, New York, New Jersey, Massachusetts, for unemployment type reasons. So let's look at a case example because I think this will help drive home this concept. We were working with somebody a couple of years ago that hired a freelancer and treated them like an employee without withholding taxes. So they're a 1099 contractor. And if the IRS reclassifies them as a W-2 employee, you could owe 100% of the unpaid payroll taxes plus penalties. And now a lot of people might think, well, that's not a big deal. It's like a couple $1,000s here to the contractor, a couple $1,000s there, but things can start to add up. And in this scenario, let's just say that you were paying somebody $50,000 a year. Just in FICA taxes alone, that's $7,500 in FICA taxes. Now, if you did this for 3 years, that's $22,500 in FICA taxes. And if you had 10 workers that you were doing this for, that's $225,000 in FICA taxes. And one thing to think about is that's just FICA taxes. That's not factoring in penalties, interest, unemployment taxes, and anything else. So this little thing, this little piece can start to add up quickly. And I think that's why it's so important that as a business owner, we look into this, because you might think, oh, $50,000 a year, if I get caught, I'll just pay the $7,500 in FICA plus a little bit of interest and penalties and move on. But more often than not, when these cases come up, it's not just 1 year. They usually don't catch on until year 2, year 3, year 4. And it's usually not just one employee or one worker, but it's multiple workers. So that $50,000 a year, if you go into just 3 years, that $7,500 in just FICA taxes is $22,500. Let's say you had 10 people doing that. That's $225,000, again, without factoring in penalties, interest, unemployment, and those various different things. And so you can tell that if the IRS came after you in year 3 with 10 workers that you were paying $50,000 a year, that's a massive bill that you'd get stuck with and cause a headache. And that's why you can start to see how this could potentially take a business out of business. And we've seen this happen before, and I'm hoping that today we can help avoid that. So let's talk about some red flags for the audit. What even causes typically this to raise an audit? What would cause the IRS or a state to start looking at something like this? And there's two main that we see, and there's multiple, but the two main ones that we see is when you have contractors, 1099 contractors that got let go, maybe they got laid off for a little bit of time, certain time period, but then they start to file unemployment, and they're not qualified for unemployment because they were 1099 contractors, and that starts to raise a red flag with the state. That starts to raise a red flag with the IRS. The other common factor we see is disgruntled employees, and we're going to talk about the tax consequences of 1099 versus W-2. But if you have an employee that you're treating as a 1099 contractor and they don't realize it, they're going to get to tax season and they're going to file their taxes and realize that they owe a bunch of taxes because you weren't taking taxes out for them. They didn't know what they should have been, and now they get hit with a big tax bill. That can cause some frustration, and now their account might be telling them, well, based on the facts and circumstances, you're an employee, you're not a 1099 contractor, so they should have been treating you as an employee, and that can lead to bringing that up to the IRS. That can lead to bringing it up to the state government. And so those are the two areas where we oftentimes start to see this get flagged. Again, you have 1099 contractors that got laid off, let go, whatever it might be, and then they file for unemployment, but they don't qualify for unemployment because they weren't employees. They were 1099 contractors. or you have disgruntled or a frustrated employee based on taxes that they weren't expecting, and then they start to report that to the government agencies. So let's talk about the solution. Let's talk about the IRS three-factor framework. So when the IRS looks at should it be an independent contractor or should it be an employee, this worker that you're hiring, they look at three main pieces. And they look at behavioral control, they look at financial control, and then they look at the type of relationship. So let's break down each of those. Behavior control is basically just who decides how the work is getting done. For example, if you're telling someone when to show up, what tools to use, and how to do it, that's likely falling into that employee territory. So behavioral is who decides how the work gets done. Financial control is who invests in equipment, covers the expenses, and can profit or lose from the situation. So as an example, an independent contractor typically is going to buy their own laptop or their own tools, and they're going to set their own rate. They're going to come to you and say, here is my rate, and you can either pay it or find somebody else. And so those are going to be typically an independent contractor who invests in equipment, covers expenses, and can show a profit or a loss. And the third factor that the IRS looks at is the type of relationship. Is there a written contract? Are there benefits being provided? Is this an ongoing gig or just a one-time or a project-by-project basis? And as an example, employees often get health benefits, sick days, and it's typically going to be a long-term commitment. This is not somebody that's coming in for a project, then leaving, then coming in for another project, then leaving. Typically, they're in there on a regular day basis. And so a lot of times it starts to look at control. So to break it down a little bit further, it looks more like an employee relationship if you have control. And so who is controlling that relationship? If it's you, the employer, typically gonna be more of an employee. If it's the worker that has more control over the relationship, it's typically gonna be going down that independent contractor route. So if you have control over the day-to-day details of the worker, such as specific instructions, or they're monitored by a supervisor or a boss, typically you're gonna lend it to that employee. If you reimburse the worker for expenses that they incurred, or you provide tools, equipment, things like that to the worker, again, typically going to lead to more of an employee. If you determine the price or the rate for that worker, again, typically going to lean towards that employee. If you determine when and how much the worker will be working, so you're setting the hours, you're setting where, you're setting all these different things, again, tends to lead to an employee. If you have no independent contractor agreement, or the worker operates as an individual, so no LLC or company, again, typically going to lean towards the employee side. If the worker only does work for you and no one else, and intends to work there indefinitely or for a long period of time, again, typically could be an employee. And if you provide benefits or vacation or sick days or those different things, again, typically going to be an employee. So let's look at it on the flip side. If it would look more like a contractor if they primarily decide how they're going to work. They primarily decide how much they're going to charge. So they come to you saying, here is my hourly rate. You choose to pay it or not. If they work for other companies, typically going to lean towards independent contractor. If they have expenses that they're paying for that you are not reimbursing them for, typically going to lean towards an independent contractor. If they have the possibility of incurring a loss on the job. So again, we look at that profit or loss motive. Who has that ability with that profit or loss? If it's typically going to be land on the contractor, they're going to be more of a contractor. If they bring their own tools and equipment and computer and all those different things, typically going to be a contractor. And if they work on more of a project by project basis instead of indefinitely or on a regular basis, again, typically going to be an independent contractor. So oftentimes when I'm looking at business owners and talking to them about these workers bringing on, we start to go down those lists, start to look at those different control items that the IRS sets in place. Behavior control, financial control, the type of relationship. Again, we're looking at who has control in this relationship and start to go through those questions that I just went through and start to tick on a box. Take this is an employee, or this is the contractor, and start to see where are some of these check marks being checked off based on your answers to some of those control questions. Most of the time, it's pretty black and white. I always say, imagine you're sitting across the table from an auditor and you have a worker that you're labeling as an independent contractor. Imagine sitting across from the auditor and trying to defend that. And if you can easily do that, I would say, yeah, then you can probably list them as an independent contractor. If everything you're saying and you're describing the relationship, you're describing the work, you're describing everything about that worker, and it's sounding more like an employee, guess what? That auditor across the table from you is probably gonna be thinking the same thing. So tip for listeners, if you just have a contract alone, because I get this from a lot of business owners a lot of times, they say, well, I have an independent contractor agreement, so it's automatically an independent contractor. The contract alone will not determine this. If you have an independent contractor, but everything else is lining up as an employee, they're going to be an employee. So the actual working relationship is what matters the most, not just an agreement. Now, if you're leaning towards that independent contractor, you're going through those questions, you're leaning towards an independent contractor, then it's important to have a solid independent contractor agreement, because that's just going to help defend it and support it. And the biggest thing that I always say is if you go independent contractor, just make sure your employees or your workers understand what that means, that they're being classified as an independent contractor. They're going to be a business owner now. They're responsible for withholding taxes and paying estimated tax payments. Make sure that they understand it, because remember, one of the triggers to this is disgruntled employees. And so if you make them aware of it, that's going to avoid that from the beginning. Now, some states have even more strict classifications than just what the IRS has. California, as an example, has the AB5 law, which can be a little bit more nuanced. It can be a little bit more strict. So just make sure you're also looking into what your state classifications are, as well as what the IRS classifications are. Now, the next thing I want to talk about is the tax treatments of each, along with different types of tax strategies that we talk about when it comes to making this decision. Now, real quick, are you tired of not getting straight answers from your accountant? Are you tired of hearing "it depends" every time you ask about saving on taxes? At TaxElm, we help business owners like you pay the least amount in taxes legally and confidently. You get unlimited access to our team of tax experts. You get a custom strategy built for your business, and you get step-by-step guidance to actually implement tax savings. This isn't just theory. They are proven strategies that work, and we back it with a 30-day money-back guarantee. Click the link in the description to book your free discovery call with our team today. All right, back to this idea of contractors versus employees. And I want to talk about the tax treatments of each, because this is really what comes into play. So let's first look at an employee. What's the tax treatment of an employee? With an employee, you as the employer withhold taxes. That's income taxes, Social Security and Medicare taxes. Those would also be called FICA taxes. You withhold unemployment taxes. That's also part of your job as the employer when you have an employee. At the end of the year, you're going to issue them a W-2 which reports all this income that they had, all the taxes that you withheld for them, what that looks like, along with any other benefits from it. And as an employee, you as the employer pay half of Social Security and Medicare. You pay half of FICA taxes, which is a little over 7.5%. Now, the employee will cover the other half, but you're still withholding it for them. So FICA taxes total is around 15%. You as the employer cover half of that, and then you withhold the other half from the employee's pay. And oftentimes with an employee, they may get benefits like a 401k, health insurance, various different benefits that you might offer them as well. Now with independent contractors, complete other side of the table, there's no taxes withheld. You don't have to worry about withholding taxes from the payments that you're making to them. You just pay them what they're earned, and then they're responsible for that. They pay self-employment taxes on that income. They receive a 1099 at the end of the year. So you're going to send them a 1099 that shows, here's how much we paid them. There's going to be no withholdings on that. You're just saying, here's how much we paid that contractor. They're going to be responsible for quarterly estimated taxes. They're going to be responsible for filing that income on their personal tax return. Often that's going to be a Schedule C. Maybe they're operating as a business. Maybe it's going to be an S corporation or something like that, but they're responsible for filing their business tax return. And the good thing about that is they can also deduct business expenses against that income that they're earning with you. So the key contrast between these two is that employers carry the burden with employees, and contractors carry the burden and get the tax deductions. So employers, when you have employees, you're going to be withholding taxes, you're going to be sending them into the government agencies, you're going to be filing payroll tax forms, you're going to be filing a W-2 at the end of the year. With contractors, as an employer of a contractor, you're just making their payments and that's it, and you're sending them a 1099 at year end. So that's the black and white difference between the two. Now, when we talk about practical steps, and there's this kind of gray area, I often tell business owners to go through the different tests and think about control, because oftentimes there can be a gray area. And if you decide that if your worker that you have, it's in that gray area, and you want to decide to go the contractor route, just ensure that you have strong evidence to support that. Have a solid contract in place, have a clear scope of what's being completed, how it's being completed. You have an agreement of what's being done. Make sure you have payment terms that are clearly outlined, and make sure there's independence there. You remember, you need to, if you're going that contractor route, you need to have the contractor be in control of that relationship. So check how integrated they are, full-time versus project by project. Be aware of long-term contractors because that can sometimes start to raise a red flag. And the longer and more routine or full-time the relationship is, the more it starts to look like an employment. So if you're in that sort of gray area, don't worry, maybe talk to a tax attorney, get a second opinion. If you're part of Tax Helm, open up an Ask a Pro, give us the situation of what's going on, and we can give you our opinion too. Just make sure that if you decide to go that contractor route, make sure you have enough support. Again, act like you're gonna be sitting across the table from an IRS agent or a state agency agent and explain the situation to them and make sure it sounds like, yeah, they could be on board with it, saying this is a contractor, not an employee. All right, so now let's talk about tax strategies. And the first thing I want to talk about is you as the business owner. Let's just say you're a solo business owner, you have no employees, but then you start to bring on employees. The key thing that you want to remember is that you may start to lose access to some tax strategies like a solo 401k. Maybe you're maxing out your solo 401k and you're doing all these different fun things with your solo 401k because you have no employees. Once you start to bring on more regular employees, you're gonna have to do similar things to them. You're gonna have to treat the employees similarly to how you would treat yourself as the owner employee. So you may choose, if you're saying, okay, we're gonna hire employees next year, you may choose to do a super high contribution, especially the year before you hire. So just make sure that you understand that as the employer, that once you start to bring on employees, it does limit some of the potential options when it comes to tax strategies, specifically around retirement planning. But now I want to talk about the tax strategies for you, the worker. Let's say you're a worker and you're listening to this and you are a 1099 contractor. I want you to be aware of the power that you have behind you as being a 1099 contractor. Now that you're a contractor, you're a business owner and you have to treat this like a business, which means that you get access to business deductions. You're gonna take your income, your 1099 income, and then you're gonna be able to take expenses to offset that. And whatever's left over is gonna be considered your profit. And you're gonna pay taxes on your profit, not your gross, not what's shown on your 1099, the profit. So that's gonna be your revenue, your 1099 income minus expenses. So think of things like home office, automobile, whether you're using mileage or actual, health insurance premiums, taking advantage of travel, meals, technology costs, cell phone, internet. Maybe you're setting up a board for this business that you have. Maybe you're hiring kids in that business. Whatever it might be, you have a ton of potential to help offset some of that income so that, hey, you might have made $100,000 in 1099 income, but how can you take money that you were spending anyways, but now find a business purpose for it now that you are a business owner and get a tax deduction for that? It also opens up the door to retirement opportunities to put in place. Maybe it's a solo 401k, maybe it's a SEP IRA. It opens up the door for you to put more into retirement and different strategies around that. You know, once you have income that hits $50,000, $60,000 in profit, you might start to look at an S Corp election to save on some of that self-employment taxes that you're gonna be hit with. So these are all things that you as a business owner are able to now take advantage of. And remember, your employer, your worker, the person you're working for is not withholding taxes for you. So make sure you're making estimated tax payments to help make payments against that future tax bill. Now, one of the biggest things that I want to say to you as a 1099 worker, treat your independent contractor gig like a business from day one. Separate your bank account, have a business bank account for all that income and expenses. Use bookkeeping software to track what type of activity is going on. And number one, and this is why we're here, be proactive about tax planning. The type of strategies that we talk about weekly on our podcast, in our newsletter, on our YouTube channel, are all going to start being relevant to you. So make sure that you start to dig into that. Tax planning is a super strong possibility for you now that you are a business owner. You might be thinking, well, I was W-2 and now I'm 1099, so I can't offset that, or I'm just doing the same thing I was before. But you'd be surprised on how many opportunities there are to take spending that you're gonna do anyways, but instead of paying for it using after-tax dollars, we can start to find a business purpose for it and move it into the business to help offset some of that income that we're making. So making the right choice between a contractor and an employee isn't just about saving a few bucks on taxes. It's about building a sustainable, protected, and legally sound business from day one. It's about managing risk so that you can focus on what you actually do best, growing your company. To recap, just remember the three areas of control that the IRS looks at: behavior control, financial control, and the relationship of the parties. Analyze your working relationships through that lens, and you'll be in a much safer position. Getting this right from the start is one of the biggest financial decisions that you'll make as a new business owner. It protects your money, it protects your future, and it protects your peace of mind, knowing that you're doing it right. Now, if you found this valuable, do me a favor and hit that like button and subscribe for more critical insights that keep your business safe and profitable. And if you're wrestling with this decision right now, let me know your biggest question in the comments below. Let's protect our businesses together. If you want help from our team of tax pros implementing this strategy or questions about this strategy, along with every other tax strategy that there's out there possible, visit taxelm.com, that's TAXELM.com, or click the link in the description for a free discovery call with our team. We are helping business owners like you legally lower your tax bill every single day. Thanks for watching, and I'll see you on the next one.